You look at your paycheck, pay your monthly bills, and wonder how anyone ever builds real wealth from scratch. It often feels like setting aside $50 or $100 a month is just throwing pebbles into an endless canyon, leading you to think that financial freedom is strictly reserved for lottery winners or trust fund babies. But the truth is, the most reliable path to lasting wealth does not require a massive inheritance or a lucky stock pick. It requires a fundamental shift in how you view time and a powerful mathematical engine that is already available to you. That engine is compound interest, which is simply the process of your money earning interest, and then that accumulated interest earning even more interest. Think of it as a financial snowball rolling down a long, snowy hill. At first you are packing a small handful of snow together, and the growth is barely noticeable. But as it rolls, the expanding surface area picks up more snow at an accelerating rate, until it becomes an unstoppable force of momentum. The biggest hurdle most people face is the initial illusion of insignificance. In the first few years, your wealth accumulation is driven almost entirely by your own hard work and consistent savings. You might look at your account balance after 3 years of disciplined budgeting and feel deeply unimpressed by the meager returns. This is the exact moment when the average person gives up, stops contributing, and spends the money, completely missing the invisible momentum building just beneath the surface. What they fail to realize is the underlying mechanics of exponential growth. Unlike linear growth, where you simply add a fixed amount year after year, exponential growth multiplies your baseline over time. The longer you leave the money alone, the steeper the upward curve becomes. Your money starts working an invisible second shift, generating income while you sleep, while you take vacations, and while you focus on advancing your career. This brings us to a foundational concept known as the time value of money. Simply put, a single dollar in your hand today is vastly more powerful than a dollar you might receive a decade from now, because today's dollar can immediately be put to work in the market. Every day you wait to invest is a day of lost compounding potential that you can never get back. Time is doing the vast majority of the heavy lifting, so you do not have to. Consider a scenario based on historical market data from standard stock market returns. If you start investing just $200 a month at age 25 and earn an average annual return of 8%, you will have accumulated over $698,000 by the time you reach age 65. Your total out-of-pocket contribution was only $96,000. The remaining $602,000 is pure growth generated entirely by the relentless math of compounding. Now, imagine you wait until age 35 to start that exact same financial habit. You invest the identical $200 a month at the identical 8% return until age 65. You will end up with roughly $298,000. Waiting just 10 short years cost you $400,000 in final wealth, despite the fact that you only missed out on $24,000 of actual contributions. The numbers are staggering, but they naturally lead to a critical question. Where exactly do you put your money to capture those kinds of returns without taking on reckless, unnecessary risks? Keeping your cash in a traditional checking account certainly will not do it, and navigating the vast, complex landscape of the financial markets can feel deeply intimidating for anyone just starting out. Before choosing an investment vehicle, you must understand the invisible force actively working against your cash, which is inflation. Inflation is the gradual, persistent increase in the price of goods and services over time, which steadily erodes the purchasing power of your money. If you hide your savings under a mattress or in a basic account paying zero interest, you are actually losing wealth every single year because your money will buy less tomorrow than it does today. To outpace inflation and truly harness compound interest, you need the right investment vehicles. For many new professionals, the absolute best starting point is a workplace 401k plan. This is a highly effective, tax-advantaged retirement account where you can automatically funnel a portion of your pre-tax paycheck directly into investments. Even better, many employers offer a matching contribution, effectively giving you free money that immediately increases your baseline for compounding. If you do not have access to a workplace plan, or if you want to invest beyond it, an IRA is your next powerful tool. An individual retirement account allows you to build wealth with specific, highly beneficial tax advantages. The Roth version of these accounts is particularly potent for young adults. With a Roth IRA, you contribute money you have already paid taxes on, but your investments grow completely tax-free, meaning you will not pay a single dime of taxes when you withdraw that massive compounded balance in retirement. Inside those retirement accounts, you need to choose what assets to actually buy. This is where an index fund becomes your greatest ally. An index fund is a type of mutual fund designed to passively track the performance of a specific market benchmark, like the largest 500 companies in the United States. Instead of trying to guess which single company will succeed, you are buying a tiny, highly efficient slice of the entire profitable economy. Buying an index fund instantly provides diversification, which is the critical practice of spreading your investments around so that your exposure to any single economic failure is minimized. If one company in your index fund goes bankrupt, the other 499 are still working tirelessly to grow your wealth. It is the ultimate defense mechanism against the unpredictable nature of individual corporate failures and market surprises. Another highly accessible way to buy into these broad markets is through an ETF, or exchange-traded fund. An ETF functions very similarly to an index fund, holding a diversified basket of assets, but it can be bought and sold throughout the day just like a regular stock. They typically carry extremely low management fees, meaning more of your hard-earned money stays in your account to benefit from compounding rather than lining the pockets of a wealthy fund manager. Of course, knowing exactly where to put your money is only half the battle. You have to actually free up the cash in your daily life to invest. A highly effective framework for this is the 50-30-20 rule, where 50% of your income covers essential needs, 30% is allocated for personal wants, and a strict 20% is dedicated to savings and debt reduction. Carving out that 20% is how you consistently fuel the engine. The most successful wealth builders do not rely on sheer willpower to invest that 20% every month. They rely entirely on automation. By setting up automatic transfers from your checking account to your investment accounts the very day you get paid, you remove human error and emotional hesitation from the equation. You pay your future self first, treating your monthly investment contribution as a strict, non-negotiable bill. As your automated contributions begin to accumulate, you will inevitably face periods of intense market volatility. The broader economy will experience downturns. News headlines will scream about impending financial doom, and your portfolio balance will temporarily drop. This is the ultimate test of your psychological resilience. Panic selling during a market downturn locks in your temporary losses and permanently breaks the delicate chain of your compounding growth. During those scary moments, remember that financial snowball rolling down the hill. A market drop does not melt your snowball. It simply means the snow is temporarily on sale. Because you are investing consistently through automation, market downturns allow your monthly contributions to buy more shares of your chosen index funds at a significantly lower price. When the market inevitably recovers, your larger collection of shares will compound even faster. Surviving those inevitable downturns brings you to the middle years of wealth accumulation, a phase that is notoriously boring but incredibly vital. You are no longer a struggling beginner, but you are not yet wealthy enough to retire comfortably. It requires immense patience to simply watch the market fluctuate while you continue your daily routine. But this boring, quiet consistency is exactly what separates truly successful investors from those who chase risky financial fads. During these middle years, as your career progresses and your professional income increases, you must aggressively guard against lifestyle creep. It is incredibly tempting to upgrade your car, your apartment, and your wardrobe with every single raise or promotion. But if you remember to apply that 50-30-20 rule to your new, higher income, your investment contributions will scale up automatically, pouring highly potent fuel onto your compounding fire. If you maintain this quiet discipline, you will eventually reach a magical financial threshold known as the tipping point. This is the specific year when the interest generated by your investments actually exceeds the total amount of money you contributed from your paycheck. Your money is now working significantly harder than you are. That invisible second shift has officially become your primary wealth generator. This tipping point is heavily accelerated by the practice of dividend reinvestment. Many established, highly profitable companies pay out a portion of their earnings to shareholders in the form of cash dividends. Instead of taking that cash and spending it on consumer goods, automatically reinvesting those dividends to buy more shares creates a secondary compounding loop. You are effectively using the fruit of your investments to buy more trees for your growing orchard. Reaching this advanced stage triggers a profound, life-altering psychological shift. You transition from an anxious wage earner, entirely dependent on your next paycheck, to a confident, secure wealth builder. You start making career decisions based on genuine passion and opportunity rather than sheer financial desperation. The deep anxiety of unexpected expenses fades away because you know you have built a massive, resilient financial fortress, brick by brick. A common, paralyzing fear among those discovering these principles later in life is the belief that they have already missed the boat. While it is undeniably true that time is your greatest asset, compounding works its magic from wherever you happen to start. Whether you are 22 or 42, the mathematical principles remain exactly the same. The best time to plant a financial tree was 20 years ago, but the absolute second best time is today. Building lasting, multi-generational wealth is not a guarded secret reserved for the elite, nor does it require Wall Street insider knowledge. It requires the humility to start small, the discipline to automate your savings, the wisdom to buy broad, diversified funds, and the profound patience to let time do its heavy lifting. By embracing the relentless math of compound interest, you are not just saving money. You are buying your future freedom, one calculated step at a time.